Good evening. Good evening. We are right at 8 o'clock on Juneteenth. And I want to welcome everyone that is on. And thank you so much for supporting me and coming out or logging in. I'm so used to being in person, logging in to our virtual webinar titled Planning for Your Retirement Day. This is a very special webinar for me because Juneteenth obviously is celebrating a day of emancipation. And what better way to celebrate for me than to talk about emancipation from, I guess, our work life. So today's theme is going to be planning for your retirement. I am Latoya Maddox, going to be your host for the evening. And I want to set this up by saying I work with clients in the areas of insurance, retirement planning, investment management, and estate planning. And one of the main topics is people's one on top of their mind is retirement. Like, how do I do it? What are some of the things that I need to do to be more proactive and preparing for it? And I always kind of tell them to slow down a little bit and think about retirement as their Freedom Day. And when I say Freedom Day, meaning you're never really retired. The average person is not going to all of a sudden travel the world or play golf or just volunteer for the rest of their last, 30, 40 years in retirement is what we're kind of spending. What they're trying to do is figure out how they can maximize, their years and continue to work, but only work on the things that they enjoy. So that's why we say Freedom Day. So that's where I got my terms from. So planning for your Freedom Day. We're going to allow a little time for others to join. In the meantime, there is a quiz that is here on the screen with a QR code. If you can take out your phones, take a picture of that QR code. It's an interactive quiz that's going to ask you a couple of financial questions just to see your financial readiness. And again, thank you for those who are joining. I really appreciate coming out, helping us celebrate or ending our day celebrating Juneteenth. This is actually the second year that it was recognized as a federal holiday. I am your host, Latoya Maddox. And what I'm going to share next is just a slide that just talks about a little bit of my background. I own Infinity Financial, which is a boutique independent investment advisory firm specializing in the areas of insurance, retirement planning, and estate planning. I am a certified financial planner. I have my securities licenses as well as my insurance licenses. I also am a partner at Phoenix Associates Insurance Agency, and I also teach financial courses as well as retirement planning courses as well. I am a advocate giving back to my community. I am a member of the Financial Planning Association and also married, 3 children, dog lover. What I got in here, love to travel, love a good massage and a martini. So that's just a little bit about me, the person that's going to be speaking to you over the next 30 minutes or so. All right. So the lay of the land today, our agenda. We're going to talk about retirement planning. So where do we start? Our next steps are going to be looking at our income and expenses as it relates to retirement planning. We're going to touch on Social Security, talking about how much money we need, and then are we ready? Some of the steps that we can take to get ready for retirement. I am recording this. I have a few people that have come on a little bit later, so I am recording. If you have missed anything, which we just getting started, but if you wanted to go back and get this, I will send an email link out to everyone to have a copy of this recording. Okay, exactly. All right, so I will send out a email link that will give everyone a copy of the recording. Thanks for everyone that is on. All right. So where do we start? So some of the first questions that you have to think about when you're looking at retirement planning is where will you live? So let's start there. We are based in Georgia. Most of you on the call today or on the Zoom today are living here in Georgia, but that's actually a legitimate question when you're thinking about retirement planning. Is relocation part of your journey? Some people may decide that they may want to relocate because they want to be near their adult children. They may want to be near their grandchildren, or they may want to move to a different climate. So, for example, I am actually originally from Chicago. So, a lot of my relatives that are living in Chicago now, for far as retirement for them, they all end up coming south, either coming back to Atlanta, coming back to Georgia, coming back to Atlanta or Alabama, or even going to Florida. So, what does retirement look like for you? Very individualized. It's not going to be a one size fit all for anyone. So, you got to think, where would I live? Um, what will I do? So retirement for some could be that, hey, I think I want to either work part-time, or I want to start a nonprofit, or I want to go into consulting. Maybe you're an executive at a company right now, and you say, I want to continue to do the work that I am currently doing, but I want to do it just for myself. So you may want to go into consulting. So going through some of these questions, how much money will I need? How much money do I currently have? What does my health currently look like? What you need to do is just get a file out and just start writing or starting a journal, just organizing some of these thoughts and writing your questions down so that you can start collecting them so that you can get your retirement picture. So, what about a budget? So, a budget in retirement is just a spending plan. It's going to take into account all of the income that you're going to expect to receive. And then it's going to allocate that income to your specific expenses that you have in the coming months. So it's going to figure out where your money actually goes. The budget also is going to help you set limits on the amount of your expenses based on certain categories. And then it's going to help you reach your financial goals. It's almost like when you think about dieting, one of the first things that a nutritionist is going to ask you to do is they're going to say, well, you know what you need to do? You need to keep a food diary. Let's figure out what you're eating. Same way with the budget. To figure out where your money is going, you have to figure out how you're spending it so that you can come up with a spending plan. And that spending plan is going to help you identify where your money is going. It's going to help you identify or put limits on the amounts of these categories so that you can reach your goals. And the thing about retirement, ideally, unless you're going to increase your income in retirement, the idea is you're going to have to live on just a little bit less than you were accustomed to in your peak earning years. So pretty much it's very important to have some type of budget. So why you want to have a budget? One, it's going to help you set some controls on your spending. It's going to help you become more organized in how you're paying out your bills and how bills are coming in. It's also going to help you spot opportunities for either in maximizing your spending dollars or even helping with frivolous spending. It's also going to give you some extra time. It's going to actually show you how you can maybe save some of yourself some time through budgeting. And then you also may find that when you're budgeting, you may find extra dollars. I actually put myself on a budget this past month. I wanted to see exactly where my expenses were going. Every now and then I get out of whack too. And I pulled out my handy piece of paper, wrote down everything that was coming out of my accounts. I did it for a 60-day period and actually found money, found some holes in my budget, found some unused subscriptions, found some things that should have been canceled months ago. So that's actually something that is a positive when you're dealing with a budget. You may even find more money. All right, so breaking down your expenses. So once you've kind of started your budget, what you really need to do is categorize your expenses. So you're going to have to do it. That can be a little cumbersome, but the main thing you want to do is look at your expenses and break them down into two categories. The first category is going to be your fixed expenses. The second is going to be your variable. And usually at this time is when I would ask the difference between fixed expenses. So we do know fixed expenses typically are those expenses that do not change over time. So an example of a fixed expense typically would be your monthly mortgage or your rent, maybe your car payment, your life insurance payment, your car insurance, student loans, things of that nature. Your variable expenses, those are things that are going to fluctuate month to month. And so those are things like food, maybe your medical expenses, maybe some car expenses, utility bills. So for the most part, you're going to be taking a closer look at your fixed expenses when you're looking at your budget, things that you can control the most. So again, when you're looking at your fixed expenses, you're going to be looking at your property taxes. You're going to be looking at your mortgage, your rent. Also going to be looking at utility bills. You're going to also be looking at your insurance, and then looking at your monthly expenses like your car loan and your lease payments. It's almost like I also have an insurance agency. And so we would hate it that when Clark Howard, he was the consumer reports guy for a while, every time he talked about people trying to save money, one of the first things he'd tell them to do is shop your car insurance, shop your auto insurance. Well, of course, that created more work for us, but it is true. Every 3 years or so, you should really take a good look at your home and your auto insurance just to make sure that the rates are still in line. We don't recommend you jump insurance companies every year for sure, because you want to build up some loyalty with the carrier. But there are opportunities where you can, save some money on your insurance. So if you needed to save money on your fixed expenses, one of the first places to look obviously would be shopping your insurance. Secondly, would be looking at your utility bills. If there's a way to go on budget billing, especially for your electricity bills, where you can budget your billing throughout the year so that you don't get hit with high electricity bills during the summer months, that's always a good idea for Georgia. Now, looking at your variable expenses, so these are expenses that can just go out of whack if you don't keep a tight control on them. So we're looking at food. Food is going to encompass both grocery at home and eating out, clothing. I won't belabor this slide a little bit too much, but food, clothing, furniture, entertainment, gifts, vacations, personal items. These are all the things that you're just going to have to watch to make sure that you're not blowing your budget on these things, especially in retirement. But these are things that you have to consider when you're trying to map out your retirement. How much do you want to allocate to this category? So now that we have taken a look at what our expenses are, the next thing we need to do for retirement purposes is now look at the categories of income that's going to be coming in. So now let's stop and kind of think about this. So we have your wages and earnings, so that's some salary. So some people may continue to work part-time or even start their own business in retirement. So you may have some wages coming in, self-employment income. The next layer would be any type of pension that you may be eligible for through your employers or your IRA distributions. So if you're working for a company that has maybe a company 401k, you may roll that 401k into your own IRA and begin to take distributions from that. So that's going to be a source of income. Any interest and dividends that you earn on your investment accounts, those also we're going to be considered income. And then that last last bucket of income is going to be Social Security. So in retirement, it used to be called the three-legged stool approach, which was Social Security, your pensions, and then your personal savings, which was your individual retirement accounts. But now we see that people are beginning to work in retirement as well as have some level of Social Security. I mean, not Social Security, I'm sorry, level of part-time work. So anyway, wages and salaries, self-employment income, pensions or IRA distributions, interest, dividends, and Social Security. So now here comes the moment of truth. So now this is the point where you're going to have to take your income minus your expenses and find out, is there a gap? So hopefully when you get to the bottom line, you want to hope that your income is more than the total of your expenses, of course. So that's going to be the ideal result. It means that that means that you're probably going to be able to live within your retirement means. Most importantly, it indicates that you probably had the opportunity to put enough money away so that you saved enough at that time. But in the event, if your income is less than what your expenses are, then that just means that we have some work to do. That means we're going to have to look at possibly some ways where we can cut some of those expenses, or we're going to have to examine ways where we can increase your income, or we can consider working a little bit longer or postponing retirement. So remember, we talked about the different levels of income. So we may need to earn a little bit more money. We may need to delay Social Security, just depending on what your numbers are. But regardless of the bottom line you reach, when you draft your initial budget, you'll have a much better handle on your financial situation that you're going to be facing during retirement, as long as you're armed with the information. I always say, one of my favorite quotes was the 5 Ps: proper preparation prevents poor performance. So we can't go in blind. If we know what our numbers are, then we know where we can make adjustments along the way. So now that we've gotten our budget number out of the way, the next number that we need to calculate is going to be our net worth. So what your net worth is, it's a calculation that is going to be based on your assets minus your liabilities. And what that's going to give you is your net worth example. So assets is going to be everything that you own. Liabilities is everything that you owe. So your assets are going to be considered any financial asset or material possession that you own. So we're going to be talking about cash. So that's going to be cash in your bank accounts, any stocks, bonds, mutual funds. So that's going to be your IRAs, individual retirement accounts, going to be your brokerage accounts, assets like your home, your cars, if you own trucks, boats, any type of toys, any furniture that you own, antiques, jewelry, coins, etc. Those will all be considered assets. So you're going to add those up. So remember that your assets are going to be valued at their current market value, not what you paid for them, but what you can hope to sell them for, what the current market value is, not what you can hope to sell them for, but what the current market value is. That's going to be your assets. The next calculation is going to be your liabilities. So now we're going to list out all of your liabilities. So that's going to be any mortgages. So if you have a mortgage on your home or mortgage on this vacation home, second home. So any mortgage obligations, any installment loans, such as car loans, credit card balances, unpaid taxes or bills, and any other financial obligations. So remember, liabilities are different from expenses. So expenses were like your food and utility bills and things like that. Liabilities are actual bills and debts that you owe. These are often larger, and like I said, they're debts owed to others. Many are even secured by an asset, so like your mortgage or your car loans. So your house is going to be considered collateral for your mortgage. Your car is actually collateral for your auto loan. And then you're going to come up with your calculation here. Assets minus your liabilities is going to be your net worth. And again, even with this number, you may be surprised and even relieved. You may have a positive number. But again, you need to know your numbers. So why would you want to calculate your net worth? It's going to serve a couple of purposes. One, it can help you obviously knowing your financial status when you're going to apply for a loan. But if you're preparing for a retirement, kind of calculating your net worth is a way to start gathering all of your assets. It's going to help you as you begin to prepare for your will, preparing a will. So this is going to simplify things because you've done most of your homework on your net worth. Since you already know right away where your assets are, what the values are, you can get ahead of it. Also, kind of knowing your net worth, if you're starting to think about life insurance or even trying to determine, do we need life insurance at this age? If you know that you have liabilities that exceed your assets, maybe you need to think about adding some life insurance into your financial plan. So that's another way to figure out, looking at your net worth, do you have any obligations that need to be satisfied? And then finally, your net worth is an indicator of how you're doing in terms of working towards your financial goals that you've set. So for example, as you look at your IRA and your 401k balances, you get a better idea of how you're doing as far as making sure if you won't outlive your assets. So you'll be able to see if those balances are rising, because those will be more on the asset side of things. So at this point, we have calculated our income coming in minus our expenses that are going out. Hopefully we're in the positive. The next thing we've done, we've looked at our net worth, looked at our assets minus our liabilities. We kind of know where we are there. The next step in our retirement preparedness is taking a look at our Social Security. So, of course, there has been a lot of talk about Social Security not being available for us. It will be available. There are some calculations that need to be done, but it's definitely something that will be available for us. This, what you see on the chart here now, is our full retirement age for Social Security. And I guess I'm in a chat environment. For those that are on, your full retirement age is going to be based on your year of birth. So if you're born 1960 or later, your full retirement age is now 67 years old. So for a while, most people's retirement age was 66 and some months. It's kind of how we used to always say it. But now if you're 1960 or later, the full retirement age is going to be 67. So what that means is you can begin receiving your Social Security benefits at age 67. That's going to be the full benefit. But you are able to receive Social Security as early as 62 years old. So the way the benefits run, you can receive benefits anytime between the ages of 62 and 70. And this is a very important calculation. Your benefit amount is going to be different. So for example, you'll see on the chart somebody born in 1948. That person will be able to receive full benefit at age 66. This means that they'll be able to get 100% of their benefit based on the credits that they earn. Somebody born 60 or later is going to be 67. Now, the reduction that I just spoke of, depending on how old you are, you can begin to get your Social Security benefits as early as age 62. But look at that reduction. So starting at age 62, the reduction is anywhere between between 20% and 30% based on your birth year. So someone that was born in 1960, they will receive a 30% reduction in their benefit. One of the first questions a lot of clients ask me is, soon as they turn 62, they get that retirement itch. And they just go, oh, I can't take it anymore, Latoya. I just want to take my Social Security early and retire. And one of the first things or questions I ask is, have we run our numbers? Have we looked at what your retirement income streams are going to look like? How much money do you have in your 401k? How much money do you have in an individual IRA? If you don't have enough money in those buckets on its own, Social Security accounts for about 40% of most people's most people's retirement income. And so if that is accounting for that much of your income, we do not want to reduce our benefits by 30% by taking it early, if we can help it. There are some circumstances where people have to take the Social Security early due to medical reasons. Maybe they had to retire early because they couldn't go back to work for whatever reason medically. That's understandable. But by choice, I always try to advise against it because that's a big hit. That 30% is forever. You do not ever get that back. So once you take those benefits away, it's permanently reduced. So that's one penalty. The other upside, though, is your benefits could actually increase with Social Security if you actually delay your retirement, meaning you do not receive the Social Security benefit at your normal retirement age. If you wait until after your retirement age to receive your Social Security benefits, your benefit amounts could actually increase. So someone born 1943 or later, which is most of us here, you're going to get your benefits increased by 8% for each year that you delay full retirement age. So the longer you wait, the higher the benefit. So if you work past your full retirement age, also, the more earnings are even added to your Social Security benefit. So as a result, your lifetime Social Security earnings are even higher. So that can actually boost up your benefit. Social Security used to send out this statement. They used to send it out yearly, way back in the day. Then they started sending it out like every 5 years. And now they don't send it out. So you have to actually go online, go to ssa.gov if you're not registered, but you go to the government website and you're able to log in and view your Social Security statement. And then it will let you know how much benefit you're expected to get based on your current earnings. So of course, the closer you are to retirement, the more real the number is. So I always tell people to keep a close watch on that number. Another thing to know about your Social Security is that Social Security benefits could be subject to income tax depending on your retirement, your retirement tax situation. It depends on if you're going to earn income in retirement. So your benefits are subject to federal income tax if your combined income is over a certain threshold. So what you see here is that looking at individual taxes versus married filing joint is what we're using. So if you're an individual person, individual tax filer, and you have taxable income under $25,000, then none of your Social Security is taxable. And what that means by income is going to be Social Security, it's going to be adjusted gross income plus half of your Social Security benefits. So if you're working part-time, it's going to be your part-time income plus half of your Social Security income. If that is less than $25,000, then none of your Social Security is taxable. If you fall between 25,000 and 34,000, then up to 50% of the Social Security benefit is taxable. So not taxed at 50%, but 50% of the benefit. And then if you're over 34,000, then up to 85% of your benefit is considered a taxable benefit. And then for joint, that threshold is a little bit higher. $32,000 is going to be the threshold. If you make less than, it's going to be not taxable.
Oh, time so fast.
32,044. Was there a question? 32,000 to 44,000, 50% of the benefit will be taxable, and then over 44,000, 85. So I don't want you to be a tax expert, but I just want you to know that in retirement, your decision to work or your sources of retirement income does have an effect on your Social Security benefit. So when we're calculating how much money we need to make sure that we're factoring in that a portion of that Social Security benefit can be taxable. And then lastly, on Social Security, far as earnings, if you receive Social Security benefits while you're working, and this is only if you're taking the reduced benefit. So if you receive Social Security while you're working and you are taking the reduced benefit, you're limited to how much money you can actually make. And I won't go into all of the calculations because it can get complicated. But if you are working, you are limited to only making $21,240 a year. And that's for 2023. If you earn more than that, then there is a calculation that you have to pay back $1 for every $2 that you earn over. And in some cases, $1 for every $3 that you earn over. So it's important that if you take a reduced benefit, that you're factoring in that penalty or that earnings limit as well. Now, to apply for your Social Security benefits, the only thing you need to do is go down to the Social Security office with a proof of your Social Security number or your card, and then information about where you live, and a copy of your tax return, and then where you would like your Social Security payments to be deposited in your bank account. It takes about 3 to 4 months for everything to get started, but it is your benefit. Once they verify who you are, they will calculate what your Social Security benefits will be, and then they will start. So we have figured out what our income and our expenses are. We got what our net worth is, factored in our Social Security. Now the fun part is, how much money will I need? So rule of thumb, which I don't really like a rule of thumbs, but rule of thumb is anywhere between 75 to 90% of your current income is what they're saying you would need to live on in retirement, right? So the average person is using about 30 to 40% of that is coming from Social Security. So the rest of it needs to come from other sources. So these are our other buckets here. So about 37% is going to be coming from Social Security, 28 is going to be from self-employment or other income earnings. Asset income is going to be investment earnings, private pensions, government pensions, and then we have others. So again, the bulk of most people's income is going to be coming from retirement, which kind of gives me back to my soapbox of, if you can help it, try not to delay retirement. If you can also help it, take advantage of trying to maximize the increase in your Social Security benefit, because that's a guaranteed benefit that you're going to receive for the rest of your life. Another key thing to factor in about retirement income is inflation. So thinking about retirement, if you're retiring at 67 years old, it is not uncommon for people to spend 25 to 35 years in retirement. And so when you're thinking about inflation, these are just some examples about housing. So average cost today of a house in Florida, $361,000. 5 years, in 5 years, that same house is going to be about a 418. 10 years, they're saying it's 485. And then they're going to use a vacation, a 10-day cruise, 1,500. And in 10 years, that same trip's going to be about $2,000. And then a recreational RV today, 73,000. 10 years from now, 98,000. And this is based on 2023. I even think these numbers are kind of low, because what we got to understand is that we are losing a lot of our purchasing power due to inflation right now. So that's going to be, I think, the driving force. That's going to be one of the, what I would say, that's going to be one of the time bombs in a lengthy retirement. It's going to be inflation. And then the other thing is going to be our life expectancy. So the average life expectancy, we know we're living longer because of medical reasons. We're also are becoming more healthier. So it's not uncommon, like I said, to spend, 20, 30 years in retirement. So a 65-year-old male can definitely expect to live to 83, but I'm definitely seeing people living into their 90s and even 100s now, especially women. And then 65-year-old females are expected to live to 86. So we have inflation that's kind of keeping us here. Life expectancy obviously is longer. And then we also have the rising cost of medical insurance or medical expenses. So someone that is 65 retiring in 2022, or a couple, they would need at least $300,000 put to the side to pay for medical expenses throughout retirement. And this is not even factoring in long-term care. Now at 65 or at retirement, some important decisions are going to come down the pike. And most of them, well, one of them is going to be our Medicare decisions. So Medicare is something that you're eligible for when you first turn 65, or it can be delayed if you're working. So I won't go into all of those delayed rules, but if you're working and you're still under your employer's plan, you don't have to go into the Medicare arena. Once you are fully retired, then you have to roll off of the employer plan and then go into Medicare. But typically, Medicare eligibility begins the first day of the month that you turn age 65. And it has 4 parts that we need to be aware of. And there are some enrollment dates and rules around here, because if you don't enroll on time, you're going to miss out on some eligibility rules, and then you may even be penalized. So the 4 parts that we need to look at are going to be Part A, which is our hospital insurance. Part B is the medical insurance. Part C is what's called Medicare Advantage plans. And then Part D stands for the drugs, which is the prescription drugs. So your Part A, that's going to cover your inpatient hospital care. That's like your hospitalization, inpatient rehab, skilled nursing facilities, things of that nature. Part B is going to cover your doctor's office visits, outpatient care, preventative, and your preventative services. And then Part C, this is actually new. I don't say new, maybe new in the last 10 years. These are your Medicare Advantage plans. This is where your private insurance companies have kind of came in and taking over the care of those that are Medicare, that are eligible for Medicare, and they're providing health care to Medicare eligible members through HMO networks and PPO networks. And then the last section here is going to be prescription drugs. This is how you're getting prescription drug coverage if you are eligible for Medicare. And then you might consider buying something also known as a Medigap or Medicare supplement policy. And these policies are sold by private insurance carriers, not affiliated with Medicare. But what they do is they wrap around Part A and Part B and give you a little bit more comprehensive coverage than your Medicare Advantage plans. And there's a whole presentation around that that's separate. But this is a very important decision when you get to retirement as to how are you going to handle healthcare in retirement so that as you get older, we know our medical changes. We may have different surgeries. We may need different prescriptions, and choosing the right plan is very important because it does determine how much you're going to end up paying out of pocket. So if you haven't sat down with an advisor or an insurance professional for that, it's very important that you do so. So the premiums that you end up paying, so there are some costs to Medicare. Medicare Part A is usually no cost if you have worked in the US, I would just say for 10 years, just to make it easy. People who have not worked in the US for 10 years, they pay a premium for it. But most of us get Medicare Part A at no cost. Part B is now income-based. So depending on your income, depending on your taxes is how they do that. There are some charts on it. Typical premium is $174. As your income, as your higher earner, it can go up to $594 a month. And then Part C, that's going to be based on the insurance carriers. There are a lot of zero premium plans. And then your Part D, that's going to be your drug plans. Those range anywhere from $5 a month. I've seen some as high as 115, but that's going to vary based on the insurance carrier and the type of drugs that are going to be covered. So definitely there you would, just kind of want to pay attention to what your actual needs are. So again, your Medigap policies, those are called Medicare supplement policies. These are sold by private insurance companies. They're made to wrap around Medicare. And what they do is they fill in those holes that Part A doesn't cover or Part B it doesn't cover. And then long-term care, that's just a totally different animal. So this long-term care is totally different from Medicare. This is definitely something that we need to think about, if not, kind of plan for if we can, because the average cost of a nursing home for a year is over $100,000, over $100,000. And of course, it's going to vary state by state. And one of the issues with long-term care is that if you need it, meaning having someone to come into the house to care for yourself or your loved one, you're going to end up using your savings or your assets to provide that care. It's just natural. And then that puts your retirement assets at risk. So it's just something that you have to look at and just kind of plan for or figure out how you're going to handle it. So I know that is a lot of information, but the main things are just kind of knowing what your income is, knowing what your expenses are, how are you going to handle your Social Security, when are you going to receive your Social Security, what healthcare choices are you going to make. But the only way you're going to be able to do that is to really sit down and plan. So there are a lot of worksheets that are available, either online. I have some that are available as well that just kind of walks you through some of the decisions that need to be made, which means, like what are my income sources? What are my choices for Social Security? Do I want to work part-time? Things like that. What are my healthcare options? So just trying to help you kind of map it out. Like I said, it's good to get a journal and just start writing these things down because there's some very important decisions that need to be made and you just don't want to leave something out. I also use something in my practice. It's called an asset map. And I tried to put a screenshot up here. And it looks like it doesn't look too small. I thought it might be kind of small for you. But what this is a tool. I just put a sample family up. I have this tool. It's called an asset map. And what it is, and there's a QR code here if you would like to just do the discovery process. It's a tool that kind of helps you look at what you have against what you want to have. So this particular family, we have, they want to retire at the age of 65. And they want to live on at least 50% of their living expenses. So they're not looking at income. Hold on a second. I think I had somebody in the waiting room. Sorry about that. So they wanted to live on at least 50% of their income. So that's what they want. And then what they have rental property income, they have their Social Security estimate, they have 401k contributions that they're making. They also have a Roth IRA, and then they have their two Roth IRAs. And so then it just kind of backs into what they want against what they have. And then there's some software magic that happens that says, well, based on these calculations, this family is about 75% funded. And 75% funded gives us an example on what else that they need to do to become 100% funded. And what they would need to do is to try to figure out how to save about $1,000 more a month. Now, saving $1,000 or more a month could be a couple of things. It could be increasing their contributions. It could be saving on expenses, but at least we can get a baseline as to where we need to do some work. So again, I remember I talked about proper preparation prevents poor performance. So a lot of times we just need to look at our numbers. And that's what this tool does. So if you scan that QR code, it'll take you to our discovery page where you just answer a couple of questions. It takes you about maybe 5 minutes or so. And then I'm able to get a little information and we can schedule a quick Zoom and we can just kind of go over some things and I can be able to do a high level asset map for you. So the retirement timeline, typically around the age of 50, this is kind of where things begin to happen. There's some tax breaks that begin to happen. At around 50, you're able to begin making catch-up contributions in your 401k accounts. 59 and a half, this is when you're able to take out withdrawals from your 401k without taking any type of penalties, right? Age 62, this is the minimum age that you can start receiving Social Security benefits. But again, I encourage you to delay if you can, because you're going to get a bigger benefit. Age 65, you're eligible for Medicare. 66, for those born between 43 and 54, this is when you can get full retirement benefits. So there's some numbers here. Even 73 is when you have to start taking required minimum distributions from your retirement accounts. So the point here is that when you're in this retirement age, there are some age-related things that must take place. Like, for example, at age 63, if you do not take the 73, I'm sorry, at age 73, if you don't take the required minimum distributions from your retirement accounts that have required minimum distributions, there are some heavy tax penalties for not doing so. So these are just things you need to be aware of. So I call those retirement landmines. Some useful resources for you to kind of look a little further. I love, of course, AARP has everything there. Dinkytown, I love this website, is for financial calculators. The Social Security website, this is where you can actually go and register your account, register so you can have access to your Social Security record. This is where you'd be able to download your statement to figure out what you will receive for Social Security. It'll also show you how much your Social Security would be if you delayed retirement. And then Medicare.gov is going to help you and give you all the information about the Medicare Part A, B, C, and D. And then this is PSCA. This is going to give you really good retirement planning calculations and other tools. So what I would say is that when you're looking at your investment decisions and things about retirement, you have to think about a couple of things. You have to think about your attitude towards risk. So the amount of risk you're willing to handle to get the returns that you need for your investments. You also have to think about your time horizon, because when you're in retirement, you don't have 20 and 30 years to make things up. All right. And then your investment goals, how much money you'll need in order to pursue the lifestyle that you want. So obviously, the younger you are, the better. And then if you are older, you just want to make sure you're not taking on too much risk, but you want to make sure you're doing something. Now, earlier, I had put up a financial quiz for those that have taken the quiz. I do have the quiz results, but you would actually have them on the app as well. So I think I'm going to skip that slide because I had a few people kind of on the phone here. But I also wanted to say in the chat, I put a sample document And that was the retirement target plan that I put up for that family. And if you don't have it, or you can actually download it from the chat if you missed that portion. And I purposely ended a little early because I wanted to leave some time for any type of questions, because I know we covered a lot. Any questions as it relates to just the income sources in retirement?
What you presented was very informative. I did not know that the amount received from Social Security, if I have a part-time job, it would impact that I may have to pay taxes back. Something I'm dealing with right now and trying to get ahead of the game, but I have to think further down the line when it is time for me to receive my Social Security. So that was very mind-blowing and thought-provoking.
Yes, and the thing about it, so when you're running that calculation, let me just get to the number. So with that calculation, and then I will do my screen share again. So with the calculation there, it's almost like that last dollar. So that calculation is your earnings, any of your regular earnings. So if you're pulling money from an IRA, if someone else has W-2 earnings, and then you got to take half of whatever your Social Security is. So if you receive $24,000 in Social Security, so let's say you got $2,000 that year, a month, and you receive 24,000. So you have to take whatever the earned income was and then add 12,000 to it. And you see how easy it is to make your Social Security taxable. So then the question becomes, more than likely 50% of the Social Security is going to be taxable anyway. But what you want to do is stay away from making it 85% taxable, right? So now you got to do the calculation as to how much of a part-time job can I have before I make it 85% taxable, and then I negate the benefits of my part-time job. Does that make sense?
Absolutely.
Okay.
It does make
I hope
sense.
I didn't confuse you, because when I'm talking to clients, I say that, because more than likely it's going to make it taxable depending on how much money you're earning. So if you get to the 50%, then you just got to make it where, okay, I'll do that piece. But if I flip it and now I'm at 85%, now is the part-time job worth it?
Mm-hmm.
So then
that's
you got to look at it that way.
Yeah, that's where I am now.
Okay.
Thank you.
You're welcome. Thank you for that question or observation. That's a good one, because a lot of people forget. They don't think about it. Well, you really don't think about it till you get hit with that first tax and you're like, where did that come from? Okay. Well, this was really good. I am glad I was able to get you guys on.
Thank you. Yeah, thank you for the information, though I've already retired. But what was an eye opener for those in the school system does not pay into Social Security. So you would have to do a part-time job to get Medicare paid for in the A&D.
Oh, did not know that. But do
Well,
you get your own insurance? Do you keep the school system's medical or no?
yes, you can, but you still have to. There are a couple of things that have to happen since the school system does not pay into Social Security. And if you're already retired, you must get your um, Medicare taken care of at 65. If
Okay.
not, then there are some other things. Yeah, when you turn 65, it's the must that you would require your Medicare B number. It's tricky with the school system. But you can stay on their insurance, but you still have to pay a subsidized amount. You still have to pay some money out because you have not earned the Social Security. You end up paying some money for these.
And so you only need 10 years of work history. So I guess it'd be good for you to get a part-time job throughout the year so you
I
can
did.
qualify. Okay.
I have worked, yeah, and that's what I did. But That's the only way I got A and B taken care of because I did do something part-time after retirement, but I had points before that. But
Mhm.
yeah, it's a tricky thing with the school system.
Okay.
Is your pension considered income?
Yes. Yes, your pension is considered income. So what happens with your pension, you're going to get a 1099-R typically, and that is considered income. Now, what is not considered income is going to be like tax-free municipal bond income, but we didn't get into like Roth IRAs because that's a different thing, but Roth IRAs is very popular. You don't get current tax deductions for Roth IRAs, but the investment earnings grow tax deferred. And when you pull the monies out of a Roth IRA in retirement, it's tax-free. So when I'm working with my younger clients that have the time, especially my 20-year-olds that have the time to build up, because with the Roth IRA, now your companies are doing Roth 401k, so you can do that too if you have one and try to put as much money in it as you can, because now you're setting yourself up to have tax-free retirement income that will not affect your Social Security. Now, how long they keep that loophole open, I don't know. It's a great thing. So I always encourage people, if you have access to a Roth, you're not going to get the current tax deduction. But what you're going to get still is the tax-free deferral of the tax deferral on the gains. And then when you pull that money out of the Roth in retirement, tax-free income, and that income is not going to count against you when they're trying to tax your other retirement assets along with your Social Security.
So when you're doing your when you're putting your pension in there, you're adding, you get your 1099 and then you add that to half of what you get for Social Security.
Yes, ma'am.
And if it's less than 25,000, you don't have to pay any tax.
You don't pay taxes on the Social Security.
You don't pay any taxes on the Social Security, but you pay taxes on the pension.
Yes, ma'am. Based on your tax rate.
Based on your tax rate.
Looks like I'm gonna be paying taxes.
And then you'll find it just, when you're doing your taxes, I also have a program where I can analyze your tax return. So if you get situations where you are owing and you're just trying to figure out what's going on, you can look at it. I also have people where they don't take taxes out of their pension because they didn't know it. And you say, well, start taking some withholding so that you're not hit at the end of the year.
Yeah,
Okay.
that's where I am with figuring out how much I need to withhold.
So you just take out some withholding. So if you've done your taxes, for 2023, I do have something that I can do where we can look at it and show what you should just withhold. And then when you do your taxes, they'll kind of tell you too, but I can look at it too, and you can see what you withhold. And that's normally what happens. You kind of get dinged the first year if you don't know. And then you make the corrections for the following year, because then you don't want to get the withholding penalty, because there is a penalty on your current tax return if you don't have enough withholdings taken out as well.
Okay.
And it's probably small if it's not a whole lot. I had one person this year with a huge one, but that's because she messed up on the W-4. The taxes this year were screwy for a lot of people because they changed the W-4 allowances on the paychecks from companies. So that was just screwy for a lot of people.
I thought so. I went back even with my part-time and I adjusted things and I said, this isn't right. When
Everybody.
I looked at the chart
Mhm.
and then I said, this is how much should be coming out and it's not coming out. So I have to remember to do that. Did they correct it or do we just have to do the withholding?
You got to do, I really feel like something's got to happen. I had a lot of people with issues, and it was the payroll departments. I mean, it was people
Right.
like you that were saying there's a problem. It was the payroll departments. I don't know what they're going to do on the back end. I think if enough people complained about it, because it was at the company levels where the problems were.
Right, with their programming.
It was with the programs. Yes, I had more people for 2023 than ever that owed taxes, and it was because they had multiple income streams from other places, and the the companies weren't allocating it based on the new with W-4 withholding, so it was a nightmare.
Okay, so this is my first tax season coming up will be my first time having to pay to do it since I retired, because I retired last December
Okay.
in 23, I retired. So the taxes that came up for this year were for last year. So that was my regular way of doing the taxes. So this year, next year's taxes will be the first time I'm being taxed with Social Security.
Okay.
So I'm just wondering, so do I just add up my pension? Because I don't get a lot of pension. So if I just add it up and add the half of the Social Security to it, and it doesn't come, and it's less than 25,000, then I won't have to pay any taxes on my Social Security.
Correct.
But you're saying I will have to pay taxes on whatever the amount of pension I got.
Yeah. So when you file your taxes, you'll be entering in all the data. So you're going to get something called an SSA 1099. So you're going to get the 1099-R from the pension. And then you're also going to get your Social Security 1099, which is just your Social Security statement that shows how much money you got in Social Security minus any Medicare premiums that was paid. And you're going to enter all of that into your tax programs. And then it'll calculate it for you. So you still give them the data, and then it'll calculate it for you.
Okay.
So when you file your taxes, make sure you still include the SSA 1099 information you get.
Okay. Because I do the TurboTax.
They're going to.
So I wasn't exactly sure how to do it, since I, will be doing entering Social Security this time.
Yeah,
but I probably should just, because I'm not having anything taken out of my pension because it's not a lot, but maybe I should just go and recalculate that and have something taken out of.
Well, just recalculate, because you're still going to get your standard deductions and everything. And then Georgia has a really good retirement exemption. So yeah, I wouldn't. Yeah, we can talk offline about that too. Georgia has a really, I think it's 25,000. I can look it up for you. Georgia has a really good retirement plan exemption, income exemption.
Okay. I tell you, they tell you don't hardly make nothing, and then they take out a little bit.
Yeah.
The year. So okay.
All right. Any final questions before I end it?
No, but thank you. Good information.
All righty. Well, I want to thank you guys for spending your evening with me. Happy Juneteenth. And this is the second year that we celebrated it as a national or federal holiday. I didn't hear about Juneteenth until I actually moved to Georgia in 97. That was
You're right.
I heard about it. I went to Georgia State University as a undergrad. That's where I did my undergrad. And then I lived in Marietta, and the NAACP in Marietta every year in 97, when I first moved there, they've been doing it way before that, but every year they had a huge Juneteenth festival.
Yeah,
And that's
gotten better. Yeah, it's gotten much better.
I need to go back because it was nice then, and I didn't know anything about it. And that's how I learned about it. And I was amazed.
So they had Solar, that was the grandmother of it on the day on the parade, and I saw the grand, Davis Grand with her. Since she's a member of the sorority, but it's just been a wonderful thing to highlight it. Ask young people about it, because a lot of young people, I asked my granddaughter, I said, do you know what it is? And she gave me this look. I said, girl, you're going to learn today. So, yeah. We just got to make sure we, give this knowledge to our children, please.
Absolutely. All right. Well, thank you so much. If I can be a resource to any of you, you know how to find me, and enjoy the rest of your evening. I was supposed to work out, but I think I'm going to bed.
Okay. All right. Well, thank you.
Alrighty.
Take care.
Thank you.
Bye-bye.
Have a good
Bye.
evening.
Thanks.
Bye.